Hi everyone. Today let's see how are foreign shares and foreign RSUs taxed in India. First, let's see how foreign shares are taxed in India. Capital gain is the profit you make when the share prices go up. You need to pay tax on capital gains arising from foreign shares. The taxation of capital gains from foreign shares is different from how Indian shares are taxed. If your holding period is lesser than 2 years, you will have to pay short-term capital gains. The gains are added to your taxable income and taxed as per your slab rate. If it's greater than 2 years, you have to pay long-term capital gain. The gains are taxed at 20% with indexation benefit. Indexation takes care of inflation and you will pay tax on the inflation-adjusted capital gain. We will talk about indexation in detail with an example in the end of this video. Now, let's see how foreign RSUs are taxed in India. RSUs are restricted stock units usually given by employers. They are awarded on a certain date with a vesting period. So now you will get the stocks in your account only on the date they vest. That is the vest date. At award, you will have to pay no tax. And when it vests, that is when it becomes accessible to you, you will have to pay usual income tax, which will be added to your taxable income and taxed as per your slab. You can pay the tax by selling a portion of your stocks or with your own money. At sale. If you don't hold the stock and sell it at vest, then you'll have no capital gain tax. If you hold it for lesser than 2 years from vesting date and you make capital gain profit, then you'll have to pay short-term capital gain, which is sell price minus the vest price at your tax slab. If you hold it for more than 2 years, you will have to pay long-term capital gain at 20% with indexation. Indexation factors in inflation from vest time to the time you sell. Let's see how you can calculate the inflation-adjusted prices. IT department releases an index called CII every year. Inflation value is CII of the sale year divided by the CII of the vest year. Multiply this with the vest price to get the inflation-adjusted vest price. This is the CII data from 2001 to 2019. Let's look at an example. Let's say on January 1st, 2014, you are awarded 15 RSUs with a vest period of 2 years. On Jan 1st, 2016, 15 stocks will vest, that is, they'll become available to you. Assume the price is rupees 10,000 per share. On the vest value of 1.5 lakhs, you have to pay income tax. Let's say that you choose to sell 5 stocks at vest to get money to pay for taxes. Now you hold remaining 10 stocks. On July 2017, the stocks are trading at rupees 15,000 per share and you choose to sell 5 stocks. Your sale price will be 15,000 into 5, which is 75,000, and your vest value of the 5 stocks will be 50,000. Your capital gain will be 75,000 minus 50,000, which is 25,000. This is short-term capital gain tax as per your tax slab. On January 1st, 2020, the stocks are trading at rupees 20,000 per share and you choose to sell the remaining 5 stocks that you have. Your sale price will be 20,000 into 5, which is 1 lakh, and your vest price will be 5 into 10,000, which is 50,000. Now this is a long-term capital gain as you hold the stock for more than 2 years. So the inflation adjusted vest price will be the CII for 2019 to 2020 divided by the CII for the year 2015 to 2016 into 50,000. So if you look at the table, the CII for 2019 to 20 is 289 and for 2015 to 16 is 254. So it's 289 divided by 254 into 50,000, which is equal to 56,890. Your capital gain will be 1 lakh minus 56,890, which will be 43,110. And you have to pay 20% tax on this amount, which will be 8,622.